Hi, Farzan. How are you?
Hi, good evening. How are you?
All well, all well. Your sound is a little slightly low on the lower side, looks like.
Better now? Better now?
Continue speaking.
Yeah, is it better now?
Yeah, better.
Perfect.
Shruti, I think we'll start in a minute or two.
Sure, sir.
Let's not delay beyond that. Huh?
Sure, sir. Sure.
People are joining in. I think let's start.
Sure, let's begin.
Sure. Over to you, Shruti.
Just a sec, sir. I think there is some technical glitch. Just a second. Yeah. Good evening, one and all. We are pleased to welcome you all for today's session on the world of venture capital funding. Funding refers to the money required to start and run a new business. It is financial investment in a company for product development, manufacturing, expansion, office space, and inventory. Many startups are funded by their founders only. However, most startups do raise funding, especially as they grow larger and scale their operations. When startup needs funding, venture capital is one option they might consider. Venture capital funding is a type of external seed funding. It can have source ranging from a single investor to a group of institutional investors. These funds are generally categorized as high risk or high return opportunities. I'm sure each one of you will be having so many questions, queries about venture capital funding. Like, what are the stages of venture capital? What is the outcome, advantages, disadvantages? Where are these funds exactly used? So forth and so on. To help us dive deep in the world of venture capital funding, we have today with us Dr. Farzan Ghadiali and Dr. Kaustu Gargalkar. I take this opportunity to introduce our expert speakers for today. Dr. Farzan Ghadiali is the Senator India for the World Business Angel Forum and affiliated partner of the G20 Global Partnership for Financial Inclusion. As a senator, he is helping the startup companies along with SMEs with innovative business models to rise to a global scale, leveraging the World Business Angel Forum network across 111 countries around the globe. He is a mentor with Untitled Incubation Center supported by the Government of India as well as the incubation at IIM Sirmar. By profession, he is an investment banker and heads a multi-family office. He has a rich experience in the financial service industry in India and overseas. He has authored 2 books, Investing in Turbulent Times and Investing in the Turbulent Decade That Was and Beyond. He's a visiting faculty in leading management colleges like SP Jain and MIMS, to name a few. He's the chair for innovation and entrepreneurship as well as Yuva at Young Indians, a part of CII. He has been conferred with the 2021 Business Mints Nationwide Award 40 under 40 Industry Expert Investment category and Indian Achievers Club 40 under 40 Indian Achievers Year 2021. He is recipient of India Prime Award 2022, India Top 100 Professors 2022 and India Top 100 Authors 2022. Our second speaker, Dr. Kaustu Gargalkar, is an entrepreneur turned academician and innovation evangelist. He has been a speaker at TEDx platform and also founded 4 companies in the domain of machine tools and automation. Currently, he is the Dean Business Design, Innovi, and ISP, REDX at Wellington Institute of Management. He relishes the challenge of enhancing the innovation quotient of an organization by helping create new offerings to tap existing as well as new markets. As a passion, he has mentored 100 plus startups. His core areas of interest and expertise include design thinking and innovation, emerging tech and disruptive business model creation, entrepreneurship mentoring.
Let us get going. Actually.
Yeah, sir. Last 2 lines. Visualizing unique and sustainable business models is his forte. He has also authored a book. It's Logical, Innovating Profitable Business Models. We are grateful that both of you could be here today to share your insights. Over to you, sir. Thank you, sir.
Thank you. Thank you very much, Shruti, for a very generous introduction. Farzan definitely deserves it. I don't know whether I do or not, but so Farzan and the audience, I think let's have a kind of a conversation rather than a one-way presentation, right? Yeah. So for for everybody here in this audience, I will be asking some questions to Farzan, which will be obviously related to funding, startups, etc., etc., etc. And we will get as much as, chew as much as Farzan's brain as possible to get the maximum out and the maximum benefit for all of us. So here's my first question. See, the audience is mostly students wanting to start something. They have an idea, but they don't know what to do with it, how to go ahead with it, etc. Some maybe have progressed a little bit on the path of maybe developing a prototype. Some may have some customers in place, but mostly everybody is kind of raw in that space in terms of, what next? So a very naive question, what are the different types of funding avenues available? We keep hearing of, angel, seed angel, pre-seed angel, and then, venture capital, then later on private equity. And these sometimes are pretty confusing terms or unnerving terms. So I would like you to
Sure. So I think if you really look at the complete ecosystem, you could really look at the ecosystem in India has come a really long way in the last 10 years. There was a time in 2010-11 where there were about 450 to 500 registered startups that were really there. In about 2021-22, we have 75,000 registered startups. So it's a long way people have really come. This is just registered startups. I mean, put the number at 2x if you have that who have not registered under the startup domain that is really there. So what has happened is there is a lot of opportunity that people have tapped in, and a lot of businesses have started. So once you start a business, investors always look for opportunity. Like, in a multifamily office, we look for opportunities across sectors. We look at opportunity in real estate, startup, listed companies. So what has happened is if you break up the complete startup ecosystem into phases, you would really have 2 kinds of, startups or companies that are there. One is the pre-revenue and the revenue. As you said, some of the folks here probably just have an idea. They must have had no revenue that is really there. And they will require some amount of capital that will really be required to really get the first bit of revenue, or put the system in place, put an IT system in place, or put some kind of system in place. The first audience that would be there would be the angel investors. So as the name suggests, they're angel investors. They really look at more on the founder that, should we really bet on this horse, and should we really feel that these kids are really passionate about what they're talking about, and give them some amount of money. When that some amount of money, it could be a few lakhs to a few crores. wherein that much amount of money is put in as an angel investor. You use that capital as a startup and you really implement your system, you get your act going. So that is your angel investment that is really there. Now, when you really look at angel investors, I mean, they operate separately as individuals. So I can invest in my individual capacity, Sir can invest in individual capacity. Or what happens is we all come together saying that, we are a group of people that will invest in these startups and we will put our money together. Now, when they put their money together, you have economies of scale. Because when you get a startup, you need to do due diligence, financial due diligence, little bit of legal due diligence. So say if I'm an investor that is going to put say 10, 20 lakh rupees in a startup, and if my lawyer and my chartered accountant is going to take 5 lakh rupees for the due diligence, I mean, it doesn't make sense. The economies don't work. So what do? We come together. We say that, okay, fair enough, this startup requires probably 1 crore rupees. Say 10 people come together, form an angel network. So you have these angel networks across the length and breadth of this country. Like you have the Mumbai Angels, Jaipur Angels, Delhi Angels, you name the city, they have an angel network. And people come together and put money in these startups. As long as the cause is the same, as long as the investment avenue is the same and the valuation is the same, they put it in individual capacity. It's not a pooled investment as such. So I will put it in for I will put a check, say 1 crore rupees, I'll put 10 lakh, you will put 10 lakhs. And similarly, 8 more people will put 10 lakh rupees to give the whole sum of, 1 crore rupees. So that's your concept of angel investment that's there. Angel investment is really picked up in this country because the cardinal rule in this domain is probably out of 10 startups, 2 will do well and 8 will fail. But when you say 2 do well, they are not your multi-baggers. They really are wealth creators. So if you put in X, you will probably end up with 100 or 200X. But to be very honest, that angel investor doesn't know which of the 2 of the 10 are going to really become his really go-to startups. So what do angel investors do is they diversify over a period of time. You really invest in 7, 8, 9 startups, and hopefully one of these guys will become the next unicorn and there'll be a lot of wealth creation. So that's on your concept of your angel investment that is really there. Angel investment is not really regulated as such. That is there in the sense, since I'm doing it from my own balance sheet, my own proprietary capital, there's no regulation as such. So it is not really governed by SEBI or anything else. I like your concept. I will really take the money. I will really make the investment and take the money. What should really young entrepreneurs be very careful is, it's very easy to get persuaded by an angel investor. If you're a young guy and you have a great idea, if you have a great idea, and I say that I would put in probably 10, 20 lakhs in your company, give me 25%, give me 20%. If you dilute too early, too soon, you may just spoil the whole capital structure of your company. So, young entrepreneurs should be very careful that, it is very good to raise money. It's great to get money, but when are you going to raise that money? And what is it going to be? Can you probably raise money once you start doing a better valuation, better revenues is something that you should really look at. So that's on your angel investment that is really there. Then comes really your professional investors or the venture capital funds that are really existing. These are registered with the regulator, registered by SEBI as alternate investment funds. They can write checks anywhere between $1 million to $5 and $10 million. They add a lot of value because they are experienced investors of the world. They have invested in various startups of the world. So for a company to have a very recognized venture capital fund as an investor itself is a very good thing. And they have the ability to really give you multiple rounds, as they say, as I say, Series A, Series B, Series C. Just to put it to students very simply, what is ABC? The first round of funding, second round of funding, third round of funding. So every time you do a round of funding, you can add the A to the B, B to the C, C to the B, and so on and so forth. So every time you raise money, you raise more money, hopefully, at a higher valuation. So you have really your what you really say is your venture capital funds. That's on the startup side of it. Now, once you become probably an established growth company in which you're making reasonable profitability, you're really having a reasonable scale, that is where you have your private equity funds that will really invest into more matured companies. So when we really look at the startup ecosystem, the private equity folks will not really look at it because they are going to talk about 10 million plus in terms of investments, minimum 10 million, going up to a few hundred millions that are really there. And they look at more mature companies that are really there. Also, what has happened in the last few years is there's something called venture debt funds that have really come. So basically, if I'm a startup, if venture capitalist is giving me a certain amount of money, what am I giving in return? Students should really understand the only power they have today is their equity. Equity can only be 100%. If you give your equity 100%, you're done. You move away from your company. You sold your company. So what happens is today, if I go to an investor, whether angel investor or venture capital investor, and raise say $1 million or $2 million, but I'm short of certain amount. What is the typical thing to do for any business is to really take debt. Unfortunately, in this country, a bank will not really give debt to a startup for two reasons. One, track record is not there. Second, the most important, there is no collateral. Like today, if you and me go to a bank, they'll say, great projects are, both acha project hai. 5 crores loan you want, give me 5 crores collateral. And unfortunately, a startup doesn't have a collateral. So you really have these debt funds that have come, what are known as venture debt funds. So they will give you debt at obviously a risk-adjusted higher rate. So you're not going to get the money at 7 and 9%, but you'll probably end up getting money at 12 and 15, 16, 17%. But you're paying debt. Now, what students need to understand is debt is something that is very good for the business because you take debt and you pay back the debt. It's paid back. But once you dilute equity, it's almost gone. I mean, unless you do a buyback, unless they allow you to do a buyback. So you have your venture debt funds that have really, really picked up. So over the last decade, I think this whole ecosystem of really funding has really, really picked up. And undoubtedly, India is moving towards becoming the startup capital of the world. Estimated that by 2024-25, we'll have about 250 unicorns. Now, when you say unicorns, what do we really mean? We are looking at companies with a valuation of really $1 billion. Now, with the dollar almost at 80, I mean, $1 billion is a lot of money. It's a lot of money. So what are these startups really doing? These startups are really doing things in 3 and 5 years what other conventional companies took probably 2 and 3 decades to really look at. However, when we really look at the startup world, it's very different. It's a different lens. It's a different approach we are having in terms of, way investors look at it, and way also probably owners of, entrepreneurs look at it. When we went to college and when we studied, what was the cardinal rule? Profitability is the king. Okay, you need to make profit in a business. You get into a business, you have to make profit. However, in the startup world, profitability has no significance. What is significant is market share. So these folks will say that, okay, if you are in a certain domain or you are in a certain industry, no problem. I will give you X amount of money, X $1 million of money, keep getting market share, and whether you make a profit or you don't make a profit. So, the mindset required for young entrepreneurs needs to change. If you had to start a small shop or a company, aim is profitability. But if you had to start, if you had to start a startup with the ability to scale fast, you will have to look at market share and get out of the fact that profitability is really something significant. So it's a shift in mindset for the investor. At the same time, it is a shift in mindset for the entrepreneur that is really, really there. Also, what has changed in the last probably 3-4 years is really we in India, we also have what is known as your startup platform, like the Bombay Stock Exchange has a platform on which startup companies can be listed. About 15 companies already listed on the startup platform, and they have raised some amount of money that is really there, and that will pick traction. So overall, I think the avenue that startups have today is really increasing by the minute. A lot of investors are really, really showing return because now startup has become an asset class that investors look at. I mean, it is like, okay, if I'm going to have X amount in the stock market, X amount in the real estate market, X amount in probably say foreign equities, I would have certain percentage even in startups. Yes, the percentage could be smaller at a portfolio level for a large investor. If a large investor has $1 billion of a portfolio, maybe his startup has say 2%, 3%. But that is significant amount of money, and the number is increasing by the minute. So I think we've really come a long way in the last decade in terms of, the overall ecosystem and the kind of investors that are really there.
Great. Thanks, Farhan. So broadly, you talked about different avenues for funding, right from pre-seed angels, venture debt funds, VCs, private equity, of course, is something that a startup need not think about right now.
Correct.
But that's when you achieve real scale, when you
True.
need more than maybe $100 million or something like that. That's where the P's come in. Then you interestingly mentioned about the startup platform on the BSE. Now, that also would be when the startup really has some traction, right? When they are ready to get started, right?
Yes.
Now, mostly our audience is just about starting, just about getting their first customer or so. So kind of let's talk a little bit about these angel networks. You passingly mentioned about Mumbai Angel Network, Jaipur Angel Network, etc., etc., etc. So broadly, I presume there are about 25 to 30 angel networks
Absolutely. Yes.
across the country, right?
Correct.
In fact, even in Bombay, there are something like Navi Mumbai Angel Networks and North Mumbai Angel Networks and things like that. So students, you can Google up and you'll find multiple angel networks there, and all these are kind of entry into those. They have their websites. You can put your upload your pitch deck, and somebody from there, representative from there, will get back to you after it has been evaluated, etc. So that can be explored a lot on your own. Now, that's one part of how to get noticed. And a lot of times you will also notice startups that an investor is a part of multiple angel networks.
Absolutely.
So suppose I am a startup and I'm applying for funding in, say, Mumbai Angels Network, and unfortunately I don't get a chance to pitch, or even if I get a chance to pitch, I don't get any investment. But maybe one of those investors who likes you, but has not been able to get other angel investors interested in your company. Maybe he or she is a part of maybe Navi Mumbai Angel, and he or she might introduce you there. So it's always good to have your pitch deck ready and apply.
Absolutely.
So that's one thing done. Now that brings me to what should your pitch deck be like? How should you communicate your story? Is what I would my next question to the veteran.
Sure. I think young students that are really doing a startup, be very clear. If your motivation is fundraising, that's the wrong start. Be very, very clear. If you ask young guys that why are you doing a startup? If someone says that look, everyday startups are raising money, so that's why I'm doing a startup, I think you're just starting on the wrong pitch. Be very, very clear. Today, if there are youngsters that are really passionate about doing something on their own, and you are really filling a gap or solving a real world problem that is really, really there, I think that is where you will really get the money. That is where you will get, you'll get the investors. I mean, if you really look at the most successful startups in the world, look at an Airbnb, look at an Uber. Did they solve a problem? They definitely they solved a definite problem that is there. A lot is really said in terms of a lot is really said in terms of these delivery apps like Zomato and Swiggy. Do they solve a problem? Yes, they do absolutely solve a problem. So that is why they really got the investment that really that they really got. A lot of criticism has happened in terms of companies that have got listed on the stock exchange that, see how they have crashed. But let me tell you one thing is, if you look at Paytm, the day it got listed, the market capitalization was in excess of 1.4 lakh crores. Infosys, one of the best companies in the world in IT, took 13 years to attain a market capitalization of really 1 lakh crores. So I think, the startup ecosystem is getting there. Yes, there will be these fluctuations that will happen in terms of going up and down, but it's very much really there. Now, when you really are looking at, a pitch deck, the first question you need to ask is, what you need to address is what is the problem you're trying to solve? It could be a small problem, it could be a large problem, it could be any problem. So you need to be very clear there. Second is, how you really, when do you really require the funds? Maybe when you start up, maybe you don't, when you just start your journey, till probably you get some kind of revenue, till you get probably few customers, you may not require the funds. There is no hurry. So please remember, students shouldn't think that, this is a buffet. This is not like a buffet. It's like, whatever you get in the plate, you keep eating. You'll fall sick. Be very clear. When will you be healthy? When you really eat when you are hungry, and you only eat how much you can digest, never overeat. So be very clear there. So one, your pitch deck should really contain what is the problem it's solving, what is the addressable market, what is it that you need in terms of of your funding, why is it that you need why is it that you need this, and once you get the money today, how are you going to really show profitability, or how are you going to show sales? Be very clear today. If I or anyone else is going to give you money, to the aim is we want to multiply our capital. If today I get a pitch deck, like the other day I got a pitch deck, very good business, it said it's going to lose money for 15 years. 15 years it's going to lose money. So I said, I don't want to put my money in a company that says it's going to lose money for 15 years. I understand that probably it may take 2 years, 3 years, 4 years, 5 years. But beyond the point, you need to turn positive. So be very clear on where you're going, how you're going, what is the problem you're solving, what is it that is what is the kind of funding that you require. Also, please remember, when you're doing a fundraising, your company is doing the fundraising. It's a primary issuance. That means whatever amount of capital you need, your company needs for growth. That amount of money is not for you as a promoter. It's not that they are giving you money to really say that, wow, what a great idea you have established. As a part of the journey, you will keep growing, your net worth will keep growing, but you cannot cash out at that stage and probably at that early. So keep it very simple. Look at the addressable market. What is the addressable market? Which is the industry you're trying to address? What is the problem, or what is the solution you're trying to give? What is the competition that is really there? How are you trying to solve it? And what is, for doing that, what is the amount of capital that you really need? If total capital you say just need is 100 rupees, I'm sure you need it in phases. So be very clear that I would really look at phase one as this much, then I would have certain revenue, then relook at it, then you will have phase two, phase three, followed, following for your complete follow-up round, that kind of thing. Also, please remember, what has really happened is there is, unfortunately, because there is so much talk in the newspapers and so much talk about, the startup ecosystem. Even the Honorable Prime Minister the other day on 15th August said that, startups is something that India are really proud of. Unfortunately, a lot of startup promoters have started thinking valuation is something that they can really look at. The other day, I met two promoters with two laptops. They walk into my office and they want a valuation of 150 crores. 150 crores. So be very clear, guys. Be reasonable for valuation. I mean, just because the world is getting it doesn't mean you will get it. Be very clear. So as long as you're reasonable in valuation, you're going to create value for your investor, you're going to create value for your customer, you're going to create value for that ecosystem. I think there is a lot of potential that is there. But if you are entering as a student, if you're entering the startup ecosystem with the sole aim of raising money, I think that's the wrong start. I don't think so that's going to really work. So, keep your pitch deck when you, at least at your level, when probably, you're looking at a pre-revenue or just started doing revenue, look at what is the kind of traction you can really have. And remember one thing, the more you delay your fundraise, the better it will be. I'll repeat, the more you delay, the better it is, because then people will really believe that what you can do. Just look at it simple. If I give you a business idea that, listen, my audience is going to be 1 crore people, and I'm not even have one customer out of it. Are you going to believe me? Probably not. They'll say, okay, you have a lot of potential, we believe in you. But if I go and already have 10 lakh people as my customers and then I go for a fundraise, it gives a lot of confidence to the investor that, listen, this is what they are really aiming and this is what that can really happen. Be very clear. Idea can be good. The key is executing that idea. In today's day and age, it's not about the idea, it's the execution of the idea that is very, very important. Also in the pitch deck, very important when you start off, what is the kind of team that you really have? Very important to align. So how do you really attract the right kind of team? You may not be able to attract it with the kind of remuneration you pay, but the vision you really share. So have a very clear vision. Why are you doing this? What is the problem you're trying to solve? What is the team? All this will change in the journey. Believe me, when you start off, when you're pre-revenue, by the time you get to a few years, maybe the whole business idea changes. That's fine. That's not a problem. But at least be very clear on the aim, vision, and really how are you going to really look at it. And please remember, when you are starting up, don't have a arrogance of a startup promoter. Unfortunately, this arrogance is creeping into the startup ecosystem in India, wherein promoters really think that they can ask for anything that is really there. They can do a lot of window shopping. That is, what is window shopping? They will come to me, they will take a term sheet from me and go to 10 other investors. But remember one thing, as it's a small ecosystem still, every investor talks to the other investor. You may do it once, you may do it twice. After that, you will not really succeed. So be very clear. As long as you're genuinely looking at growth of your company, I think the potential that India has in the next 10 years is phenomenal. Phenomenal. You name the sector, you name the industry. I think there is enough potential for you to grow exponentially. That is really there. So be very clear there. As long as that is the aim, as long as you're really looking at that, put that in the pitch deck and be reasonable. Don't be unreasonable in terms of projections. Don't be unreasonable in terms of whatever you're forecasting that's really there. I think you're good enough to really raise money.
Well, yeah, thanks. Now, approaching investors also is a big challenge, right? What is generally the hit rate in terms of if you approach, say, for getting an investment? How many investors should you go through? What's the general hit rate?
Very good question. When startup promoters really start, when they have a business idea, they think they're playing a T20 match, but they don't realize it is slower than a test match. So probably to answer your question, it's 2%. So if you end up meeting 100 investors, 2 may say that, okay, it's a good idea, let's talk. They may give you a term sheet which could be completely out of sync with what you're expecting. So what do you really need to do is be very, very patient. So the hit rate is 1 or 2%. 1 or 2% is that the hit rate. What really happens with young entrepreneurs, especially in colleges, is they try it for 2 months, they try it for 3 months, and they say, boss, not happening, forget it. I go back to Infosys doing a job. I would have been better off there. I don't think so that's there. If you're really passionate about it and you really believe in it, money will follow. It will take time. It will really take time. That is really, really there. So, but the hit rate is very, very bad. The earlier you raise funds, the worse the hit rate. But remember one thing, once you are established, also please remember, where does all this money go? Once you've taken $1 million from someone and done very well, you go to the same guy, he'll give you $10 million. Why is that the case? Because it's simple. You prove your credentials. So I, as an investor, will always want to invest in my winning horses rather than the guys who are unknown. So I will really want to put more money to companies where they have already established, they have really proven themselves, they have really given exit to investors. So you have to win the confidence of the ecosystem by performing well, by delivering numbers. Once that happens, I think then that ratio, a time comes in a startup thing wherein you choose your investors. Yes. I mean, it also comes where you choose your investors. So if you are a great established investors, mind you, you don't have to go to 100 people. 100 people will come to you, and the question, the promoter will ask the investors that what is it that you will add value to my business. I mean, that's the transition, and that transition can happen in 4 to 5 years. But remember one thing, when you're starting off, when you have nothing, it's a clean slate. The ratio is very, very bad. It's like the survival of the fittest. I think if you can survive the first 2-3 years of your startup journey and get a couple of investors, I think you'll do well. If you give up there, I think, believe me, if you give it up, there is another competitor who will copy your idea or, edit your idea and still raise funds.
Right.
I think at the start stage, it's not about only the idea. It's not only about the idea. Uh, you and me can have the same idea. It's the passion we show, the vision we show. As I said, it is all about really, it's all about the entrepreneur or about the promoter at the start, less about the company. So we both would have the same idea. And if I'm more passionate about it and I'm more expressive about it, I have a better team, I will get the funds, you may not get the funds. So, you will have to work your way. So the ratio to start with is very bad, but as you keep growing, I think the ratio really becomes in your favor, that kind of thing.
Yeah, $1 million advice there. Just to add to that, from my personal experience of having been in the startup space and raising funds, etc. By the way, I built 3 successful startups, 5 bombed big time. So I tried my hand at 8. We made money. All right. So just a little bit. And you learn along the way. We have a tendency, when you are going for raising funds, we have a tendency to go to an investor whom you know well, and you feel he or she is going to invest in your idea and things like that. But over the years, what I learned was that research your investors well, find out their portfolios, find out what business they have, what industry domains they are invested in. And later on, I realized that your first pitch, when you are raising your, say for a startup, when you're raising your first round or whichever round, go to those investors who are likely to say no to you.
Correct, absolutely.
Because those are the ones who really critically evaluate your pitch, and that gives you an input to better your pitch for the one when you go to the ones who are likely to invest later. Right?
Absolutely.
So I think that's something which I realized after my second startup, that the tough guys need to be approached the first. But we have a normal tendency. We have a normal tendency of finding out the most comfortable, lowest hanging fruit. So don't make that mistake, startups. And when you go to the tough guys first, obviously you're going to face rejection. So be ready with it. And that's, as Farzan said, 20%. It's a natural law. Nature is like that. Even when a lion or a tiger goes on a hunt,
correct,
75% of the time the hunt is a failure. He or she is not able to catch prey. Only 25% of the times he or she succeeds, which means the 75% of the running that he or she does, futile, is actually building up or making him or her better to be successful those 25% of the times. Absolutely. And as the tiger or the lion practices more, maybe that 25% goes to 28%, 29%, 30%. Correct. Never goes to anywhere beyond 50%.
Correct.
So that's the rule of nature. All right, very important point, interesting point there. So now coming to, you talked about valuation. Be reasonable about valuation. Don't be arrogant. Don't be, don't have an inflated sense of valuation of your startup. Now, there are a lot of these terms which go around: pre-money valuation and post-money valuation. A lot of student startups come and ask me, what is this pre-money valuation and post-money valuation? So can you shed some light on it?
Sure. If you really look at valuations, I mean, the cardinal rule of valuing any company's profitability was profitability. That, if you have X profitability, you get a certain multiple to it, and that is what you will really get. That is the cardinal rule of really any valuation that is there. Also, please, let's understand there is a big difference between asset valuation and company valuation. Asset valuation is value of your land and building today. The company valuation is really what you're really doing is you are looking at the future and you're saying that they say how much is profitability or sales is this going to get in the future, and how much do I really pay for it today. So basically what really happens in any startup is they don't have any assets, so asset valuation is out. What you really do is basically you are discounting the future today. So we in finance have a method called really discounted cash flow. So you basically, the startup will say, I'm here at year 1, 2, 3, 4, 5, 6. This is what I'm going to really achieve in terms of sales, in terms of profitability. And I, as an investor, will say that, okay, instead of, your 5-year profitability is X, I will pay something today. But the problem is a lot of these, or most of these startups are not profitable. So that whole concept of profitability goes out of the toss. So what do you really do now? You evolve a method in which you can't really say, I like your face, so I'll give you $10 million. I like yours better, so I'll give you $15 million. Won't work that way. So what are they really looking at? They are looking at top line. Top line is sales, basically. So you are really looking at traction in terms of sales. So you will be given a certain multiple that if you are, say, in this industry, if you are, say, in the Web3 industry, or you are in the IT industry, I will give you a top line multiple of, say, 3 times or 4 times or 5 times or whatever number or whatever revenue you really generate. So what are you really doing as a startup is really chasing revenue. Now, to chase revenue, if you go down the P&L, basically you will have your sales, you will have you'll have your cost, etc. Profitability doesn't matter. So what matters in a startup is really your revenue, how you generate revenue. Now, when you're generating revenue, and say you're generating just a number, say you're generating 5 crores of revenue, and I really say that I will give you 4 times that. So you have 20 crores valuation. You arrive at a valuation of 20 crores that is really there. Now, how much money do you really need? Say you need 2 crore rupees. You need really 2 crore rupees. Okay, so 2 crores plus 20 crores is 22 crores. Okay, so your pre-money valuation is basically 20 crores. You add the 2 crores to it and you come to a post-money valuation. But what is important is for a lot of these entrepreneurs to understand that there is no cardinal rule of valuation. Like in the stock market, you always have really matrices of valuation that, this sector will go at this multiple, this book value. But the problem is, because you don't have no profitability, you can't really do any profitability multiples. Because there is no balance sheet strength really in terms of reserves and surplus, you cannot really do in terms of your book value. So you're really you're chasing only one number, and that is your top line. So be very clear, for any entrepreneur that is going to raise money, what you need to really chase is getting customer traction, get the revenue inside. Get the revenue inside is the key, because you are going to be paid a multiple of what revenue you are going to really generate. Also, you should look at a lot of peer groups. Peer groups in the sense, how do investors, when we look at startup, how do we really evaluate? So if I have a edtech startup, if I look at an edtech startup, I would really look at what is the kind of valuation the various edtech startups have got. How many times you have got done in terms of sales, how many times you've done in customer acquisition, etc. So there are established matrices for every sector that is really there in terms of your sales. You have customer acquisition, retention rates, etc., based on which you will really get a valuation. So basically, whatever amount of money that the investor is giving you, plus the valuation will be your post-money valuation. That is your concept of pre-money, post-money, and your valuation per se as such. So another risk that really happened probably in the last 7-8 months is excessive valuation. What has really happened is when you really look at valuations, remember one thing: the benchmark of valuation is the stock market, not only in India, even abroad. And we've seen a substantial correction in the stock market. Why have we seen that? Because today interest rates are going up, inflation is going high. In the US, inflation is at 40-year high, which is obviously from 9% cooled off to 8.5%. That's just a 0.5% cool off that is there, but we have a long way forward. So what has happened? There is a substantial correction that has happened in terms of valuation for listed companies. And when the benchmark is corrected to such a great extent, obviously that will translate into correction as far as unlisted companies are concerned. So today, if I had to put, say, 1 crore rupees into a Infosys that is a listed company and some other company that is unlisted, why would I prefer a listed company? Because what can happen is the Infosys share can go 5%, 10% up and down. but I will still get an exit. Liquidity is abundant when you are listed. In an unlisted market, if I want to sell the shares, there's no buyer. Where will I sell the shares? So you have really illiquidity. So in valuation, what you really have is an illiquidity discount. So that's why if you see all the fan stocks even in the US, the Facebooks, the Amazon, the Netflix, there has been a huge correction in terms of the value for these stocks over the last 6-7 months. That has translated into a big valuation correction for a lot of these startups as well, because the benchmark is that. And remember, plus the illiquidity that you add to it, So, every startup that is something on social media, don't think you're the next Facebook. Please don't think that so soon. I mean, don't expect you to, really, get the valuation really of, Facebook that is really there. It will not happen. So, it's a long journey that is really there. A very, very long journey. Google took 16 years to attain market capitalization of $1 trillion. 16 years. That's the long time. That's a very long time. The only asset class that beat Google in this race to a market capitalization $1 trillion was Bitcoins. It did it in 12 years. So, 12 years, 16 years for startup companies is a very, very long period of time. So I think, valuation is something, you should be sensitive to, that kind of thing.
Thanks for making it simple for all of us. Now, one question, like now, say, when a startup gets acquired by another large company, say, for example, Whitehead Junior was acquired by Byju's last 2 years back at a valuation of $300 million, right? That was the buyout. Now I have a question, as in the founder of Whitehead Junior was Karan Bajaj. When the company was bought by Byju's for $300 million, did Karan Bajaj pocket all the $300 million? Okay, so there is a misconception there. People assume that. Yeah. So I would like you to put light.
Sure. So let's get back to the basics. Today, as in any company, you really have what is known as shareholders. So in any company, I would be a shareholder. Say if I own 10% in a company or 20% in a company, someone holds 10% in a company. So now the question is, there are two kinds of scenarios as far as fundraising is concerned. One is called a primary round. What is a primary round? Wherein you go to an investor and say, I want money for the company. So the money comes into the company. It doesn't go to the promoter or the owner of the company. Obviously, the owner or the promoter benefits because he's a shareholder in the company, and by virtue of this money coming into the company, even his value will increase. But he or she doesn't get the payment directly. Then there's something called a secondary round. A secondary round is where someone says that, listen, I want to buy this company rock, stock and barrel. I want to buy, say, Byju says, I want to buy it complete 100%. Now in 100%, who holds the shares? Say the promoter holds 10%. He holds 10%, and say investors hold 90%. So only 10% of the complete valuation that is given goes to the promoter as his share. So if 300 million, I don't know what his shareholding at that juncture was. So if 300 million was the kind of valuation given, and his 10%, he gets $30 million of the $300 million there. So when you're really buying a company out, the respective shareholders will really get the valuation if it is a secondary. But if it is a primary round, 99%, all rounds are primary rounds. It's called growth capital, wherein they are not giving you money for your exit. They are putting money really in the business for the business to grow. So that is really a primary round. So let's take an example today. If I'm a promoter of a company, I hold 30% of that company. And I go to the market and say that, listen, I want to raise 100 crores. So someone puts money into my company at 100 crores at a certain valuation. How does it benefit me? It benefits me because obviously with that money, by default, my valuation will rise because you establish the share value with it. But you don't really get a direct exit or direct money that is really there. So be very clear. If again you're starting a company that he sold it for $300 million, misconception, he did not. When the company was sold for $300 million, he did not get $300 million. He just got the portion of the shares that he had. And by the time you get to that stage, you will have 10 or 20% maximum. that kind of thing. So
even lesser.
Even lesser, absolutely. Even lesser. I mean, I have seen promoters having 2 and 3% of a company. 2 and 3% of a company. So unfortunately, why do you have 2 and 3%? Because you diluted too early, too soon. So I met a promoter and he said that, I want to sell my shares. So when I had a conversation with him, this was a NBO, this was a fintech company. So when I had a conversation with him, I said, how much do you hold? He said, 2%. I said, 2%, and you're the promoter. He said, yes, I diluted too soon. I said, why do you want to sell your 2%? I asked him a question. I said, I'm not interested, but why do you want to sell it? He said, I have become an employee to the investors because today I'm just 2% shareholder. So what's the cardinal mistake he made? He raised money too soon. So when he looks back at history, that first thing when we started this webinar, when we looked at that you're raising that angel round, he raised 2 crore rupees, diluting 40%. So that was too early. So that time he says, boss, 2 crores was a lifetime for me. I mean, 2 crores, I had never seen 2 crores in a bank account. So when 2 crores, someone told me 2 crores, I said, take 40%. But he did not realize what gold mine he is sitting on. And today, unfortunately, he's at 2%. So
absolutely. That's one, in your eagerness to raise money, a lot of startups give away too much equity.
correct,
I mean,
absolutely.
if I'm not mistaken, I think when Flipkart was bought out by Walmart.
Correct.
Walmart, right?
Yeah.
Yeah. I think the Bansal brothers had just 1.5%.
2%, yeah, 1.5%, 2%.
1.5%. So, but of course, the valuation was a few billion. That's another thing. Now, coming to maybe one last question.
Sure.
Venture capital sounds like a very glamorous and a sexy term, right? Where do venture capitalists get their money from, get the fund from?
Okay.
What is the hierarchy?
Sure.
Yeah.
Sure. So it's a very for the students to make it very simple. It's very glamorous. It's very good. So basically, what really happens is every person has his proprietary capital. Him or her would have a proprietary capital. Now, once you identify, say, if I am a person who invests in the startups and I've made a couple of investments, what do other people? Other people will approach me, say, Farzan, do one thing. I will give you a certain amount of money. Why don't, on my behalf, you invest into startups? And we share the profit that is really there. So what happens is the venture capital really comes at the SEBI regulations. As a venture capital, I register my venture capital fund as a alternate investment fund, AIF, under the AIF regulations of SEBI. And basically, I invest certain amount of proprietary capital. Say I invest 10-20% of proprietary capital. Then I look for investors. So basically, you have really those investors that will invest into my fund, and I will manage the fund as a fund manager. So those investors are really your limited partners, as they call it in the terminology. Limited partners, they will invest into it. I, as a fund manager, will be my general partner, and I will invest into these various startups. Now, what happens is when I invest in these certain startups on behalf of my investors, I give them a minimum hurdle rate. That listen, when I make these investments, I assure you, you will get you'll at least get 10% return. Anything over 10%, we will have a certain split, because I am the guy who's day in and day out working hard for evaluating startups, etc., etc. So we will have a profit share. So basically, a venture capitalist is the registered entity as an AIF in India with SEBI. I mean, SEC has its own regulations in the US and various other countries. So it's a registered entity. But as an angel investor, remember, it's proprietary capital. It's my capital that is real. You're not really registered. That is really any registration that is really required. So basically, you go to people and raise money as a fund. So you have a $100 million, $200 million fund, which you deploy into various startups. As I said, economies of scale. Because if today I tell you that, listen, come and meet me, I will invest 20 lakhs into you, you will say too far, you stay too far. But if I say, come and meet me in London, I will invest $20 million, you will catch the next flight and come. Economies of scale, right? So, so as a fund manager, I have access to a lot of capital from a lot of investors in India and abroad. And thereby I invest into the startups that are really, really there.
Thank you. One last question.
Sure.
Some things to be careful about by the startups while they close deals with investors.
I think the first term sheet that you get, don't think that you achieved the moon and back. I think be very clear. If you got a first term sheet, it's good you've got a term sheet. A term sheet in simple terms is like a lot of people have heard of a bank sanction. Same way you have a term sheet from an investor's terms and conditions. Please read the fine print very carefully. Read the fine print very carefully and consult someone, consult a lawyer, consult a experienced person in the domain. It may cost you some amount of money. Be very clear when you go to a lawyer, or probably when you go to an experienced investment banker, it may cost you some amount of money, but you will have to read the fine print. You don't agree to everything that is really there. And remember one thing: because one guy is giving you a term sheet, it doesn't mean you have to really say yes to it. I have seen promoters that have said yes without reading a term sheet. That how much value? 2 crores. हाँ sir, done. ठीक है, done. Done. चलो sir, तो पैसा कब आएगा बता दो आप. They're so excited about the whole concept that they have seen light. In a way, a lot of when you really look at it this way, startups get money in terms of millions of dollars, where SME companies don't get it in lifetime. So I remember there was a startup that he got $10 million. He said, sir, I'm from a business family, middle class business family. 2 generations we've never seen $10 million in our bank account. How can I say no to this? So पैसा भेज दो आप, बस पैसा ही भेज दो आप. So let's put it this way: there is a lot of excitement. It's very easy for the people like us who've lost hair now, saying that be patient. But for the young dynamic kids that are around, and if you get $1 million, $10 million, I agree it's a lot of money. But please read things carefully. Be very clear. Take the money, but evaluate it carefully. Don't jump on things. Evaluate it carefully. Take legal advice. How is it? Because remember one thing: if you've got one investor, you will get another one as well. That kind of thing. So be patient and evaluate. I mean, don't jump onto the first offer that is there. At the same time, let me also tell you: don't act smart and look at 10 offers. I mean, if you feel, you understand one thing, you have to be reasonable even to the investor. Because today he or she is really giving you risk capital that is risk capital that is really there. So be reasonable both the sides, where you are protected and the investor is also protected.
Yeah. All right. I think I will stop here.
Sure.
Maybe we can take some question and answers.
Sure.
There's one in the Q&A box.
Okay.
How to know this startup is actually going to be feasible in the market?
Or as an investor?
No, I mean, I think it's from both sides.
Maybe. So I think as a promoter, I think a promoter, you need to answer the question on your own: that are you solving a real life problem? That's very, very important. Is there a gap in the market that you're solving? If there is no gap in the market you're solving, you're not solving any real life problem, I think you're in the wrong space. But if you think that there is something that you're really solving, and there is, probably a niche that you can create, I think it's good enough. As an investor, I mean, I look at it as an investor. I think early stage, the vision and the passion the promoter, the founders really have. You see, one trend is you will always see the young promoters getting a lot of funds, older promoters not getting funds. It's got nothing to do with the age. It's the vision and enthusiasm. At 20 and 25, you are more enthusiastic about life than you are at about 45 and 50. That's the only thing. So, how badly you want to succeed in that. That is what really, an investor wants to see in a very early stage startup. Once you establish, obviously, numbers talk for themselves. It doesn't really matter. So just check that, is there a real problem that you're solving, or a real solution that you're giving, and is it required? I mean, is it required? Don't. Also, what has happened is, what I've seen is a lot of Indian promoters just blindly go and copy US and UK startups, just blindly copy. Fair enough. If you still think that they have done a solution there and you can implement it, you're okay. But don't blindly copy. That will not really, work as well. Because remember one thing, what did I say? Is execution is the key. It's not the idea. I mean, execution is the key. We're seeing it, look at Zomato. I mean, it's such an irony. I mean, it doesn't own one restaurant. It doesn't own one hotel. It doesn't own the car or bike that they used to deliver. It doesn't employ them on the payrolls, but its market capitalization is more than most QSR, all the QSR companies and hotels put together. So, I mean, so they are providing a solution. So I think what is the solution you're providing? That's the key that a founder should look at.
Let's take more questions.
Sure.
Shruti, can they unmute and ask, or how does this go?
No, sir, I think they have to write down the questions in question and A, and then only we can take the questions.
So yeah.
Yes, sir. They can they can write in chat box. But we have put one faculty from the each other institute, so they can ask on behalf of the institute also.
Sure.
Yes, please. Yeah. Anybody wanting to ask any questions, please go ahead. All right. I have a question.
Sure.
When you said that, multiple rounds, A, B, C, D, series of fundings,
Correct.
and at every stage, dilution kind of happens, right? The startup promoter has to give up a certain portion of her or his equity.
Correct.
Is there any thumb rule that, okay, at every round, maybe not more than this, I should dilute? Is it like that over your experience?
Not really. I mean, not really. It really depends in, financial terms, we call it as cap table, how you build your cap table. And remember one thing, a cap table is like a foundation of a building. If you want to build a 100-story building, you need a strong foundation. So if you dilute too early, too soon, as far as that is concerned, you will always have a problem in terms of dilution. Always. But if you being very clear in terms of dilution from the start, I think you should still be okay. So I think there's no thumb rule that is really there. But also please remember one thing: there are a lot of rights that the investors have in terms of tag along, drag along, anti-dilution, etc. So be very careful. I remember a startup was offered 7 crores valuation. The guy was on top of the world. He said, "Sir, 7 crores valuation for 20%. Ye to jackpot lag gaya." I said, "Great." Okay, so he went and took it. But the devil was in the detail. They said 7% non-dilutive for 3 years. So every time that he raises a second round, he had to give those guys additional equity for them to really maintain the 20% for 7 crores. So, again, as I said, be very careful there. So then after 3 years, he said, "Sir, ye to kuch hai hi nahi haath mein abhi." I said, "Theek hai, kabhi aapne padha nahi tabhi." So, that kind of thing. So that's the way it is. But I think there's no thumb rule that is such, but always look at it that you only have 100% of equity. You can not have more than that. So be very precious. That's the only power you have in the hands, nothing else that you really have. So, be prudent while you dilute, but, don't be stingy either. I mean, be very clear, that kind of thing.
So that's a strong message for, the faculties in this audience who are running incubation centers, etc. Do have somebody who is experienced in that space.
Absolutely.
Before your startup sign the term sheet with any investor. The scrutiny, maybe have a review committee which looks at the term sheet from all angles. Otherwise, our startups are going to end up losing the deal, so to say. I mean, not losing the money because it's not their money, but the growth capital, which really should be a growth capital, becomes a headache capital later on.
Exactly.
So just be careful about that. That's my takeaway from there. I think if there is no other question, we can maybe close. Shruti, is there anything in the Q&A?
No, sir, I couldn't see anything. There is nothing, not even in chat box.
Anybody from the panelists have a question? Please go ahead. All right, I think we can close.
Sir, there is a question.
There is one question.
Yeah.
Professor Dr. Anuradha Ramesh, what would be the advice on financial capital for students? Can you elaborate a little, Doctor?
Yeah, please.
Yeah, Doctor, you can unmute yourself and speak.
Yes. The question was, what would be the advice that you would like to give students on a startup? Students who are like on a venture capital, okay, they pitch the idea, they try to raise money by showing the ideas and, by giving but what would be your advice? To whom would they go to? You have angel investors, you have everybody, people trying to give them all the financial help. So who would be the best person, or who would be the first persons that you think they should approach when they are looking for a startup? Am I audible? Was I audible?
Yes.
Should I?
Yeah, Farzan. Yeah, go ahead.
Yeah, I think, Doctor, I think the first thing, they should really look at is, if they have a support of an incubation center, they should seek support from an incubation center, whether it's in college or probably otherwise. I think that's the first thing that they should look at. They should get really a mentor associated with the startups. And that will really guide that journey that is really there. As I said, there is no point in looking at advice from people that have not understood anything for a startup. Like unfortunately, I see a lot of startups. I remember one startup saying, I have a mentor, he's been 45 years in the banking domain. But there is no point in having a mentor that is 45 years in banking domain. In banking domain, you look at profitability and feasibility. Here you are looking at loss, you're looking at only top line. So as I said, the lens is different. So I think, I think the startup should really look at, associating with the incubation center, or probably a mentor from the ecosystem that he or she can trust, and the mentor can add value, and really, then look at, approaching the various angel investment forums, angel platforms, or, various things that's really there. Some bit of hand holding should be done by the mentor or the, incubation center.
Right.
Thank you, sir. Thank you.
Good evening, sir. May I ask a question?
Sure, please.
Thank you, sir, for such a detailed account regarding funding. Somewhere in your talk, you mentioned about team building.
Yes.
So can you elaborate for students what characteristics and what should be kept in mind when you're building a team for your startup?
Okay, to be very honest with you, when you're really building a team, I think, whoever you take in the team as a co-founder, there are two parts to a team. One is a co-founder and second is a team member. If you're taking someone as a co-founder, he or she should share the same passion and the vision. That's very, very important. Then where do you see your startup, or where do you see your company in the next 10, 15 years or 10 years is, that should be shared as far as the co-founder is concerned. As far as employees are concerned, it's a transient thing. People will come at every stage, go at every stage. How do you attract talent? You probably attract talent by giving them some kind of equity in the company, wherein you say, you have what is known as an ESOP scheme that is really there. So we really read, we've read a lot of startups have got listed. Like, for example, if you can say the startup that got listed, Nykaa, that got listed. The first 100 employees have all become millionaires. They become millionaires. Why have they become millionaires? Because they started early, they joined the company, they got some amount of equity, and they were allowed to sell that equity probably, or retain the equity when the IPO happened. So I think, give a part of the ownership to the team members to attract talent. And the better talent you attract, the better the startup would be there. But if you're really looking at a co-founder, or a person that will partner with you, alignment of vision is the key. If he or she is not aligned with the vision, it will not work. I mean, it will not really work. That kind of investor is not a co-founder. Be very clear. An investor is a guy who's giving you money to perform. A co-founder is a person that will help you in a domain. Say, for example, if today I am a person in finance, I don't know anything about marketing. So if I get a co-founder in marketing, he or she will take care of the marketing function and I will take care of finance. So look at a great co-founding team if you want a co-founder. And as far as talent is concerned, I think, you got to attract talent by having a good culture. So that is why if you see a lot of startup offices, they are very well made, very well made. Why is that? Because you want to attract young, dynamic talent, give them a better opportunity. So if I tell you that, if you go back to that journey that, Nykaa just started, there was a choice of someone joining Hindustan Lever or a Nykaa. Why would someone go to a Nykaa? Work culture, growth prospects, and probably stock options. That's how you attract the talent. I think that is the way to go.
Great.
Yes, thank you, sir.
Thank you. Is there anything else? Any other question? No. Yeah, somebody, Neeta Doshi has raised her hand. Please, go ahead.
What is the question?
One participant raised her hand. I don't know. There's nothing in the Q&A. Maybe she's typing. Till then,
So
Professor
Rupesh Nonde,
Rupesh,
sir, yeah.
can you elaborate on can you elaborate your role as a senator, Farzan? That's for you.
Okay, so basically, this is the World Angel Forum. So we look at
Just a minute. Neeta Doshi, if you are unable to unmute, you can type your question in the Q&A box, please. Yes, sorry, Farzan, go ahead.
Yeah, no problem. So basically, this is the World Business Angels Forum. It is present in more than 111 countries, and we cross synergize in terms of startups around the world, in terms of investment as well as fundraising. So if there is a startup, say in Istanbul, that is looking at fundraising, it is showcased to all the people around the world. And if anyone is interested and anyone really is looking at it, we look at it. Similarly, if my role is to identify good startups, I showcase it to the investors around the world. And if someone is interested, he or she can invest in it. That is what the role really looks at.
Thank you. Yeah, one question has come in. Ameya has a question. What are the three main criteria for a VC to consider when investing in an early stage fintech company?
I think fintech company or any other company, scalability. The first criteria is is the company scalable? That's very clear. Second, the strength of the promoters. When your promoters do you have the prerequisites to be in that domain that is really there? And as far as fintech is concerned, very important regulations. Because today fintech is getting around the world, it is getting highly regulated industry. So, are you regulated? Today, if you can have an idea saying that, I will do this or I will do that, but you have to comply with RBI, you have to comply with SEBI. Are you compliant in terms of regulation? Is there a gray area in terms of in terms of your compliance? I mean, you may comply today, but if it's a gray area, then what happens? So that is something that you have to really look at.
All right. There is one question from Neeta Doshi. I have 4 patented products: air pollution control, ion seeding rain, increase agriculture yield, and fig dispersion. I don't understand which one to pitch.
I think to be very honest, be very clear. It's not about how many patents you hold. It is what is the monetization of the patent that will really hold the value. So if you have these 4 patents that are really, they choose the first one which will give you the maximum monetization or cash flow. Based on that, draw up a business plan that if you're really looking at, say, air pollution is something that people are looking at, rain seeding is something people are looking at. What is the cash flow that you're really going to get from the patent? Be very clear, venture capitalists are not going to fund patents. They are going to fund the monetization of those patents. So draw up a business plan, whichever gives you the maximum cash flow, maximum yield is something that you can look at.
Yeah, just to add there, look at the market. Which patent, when you productize, has a good market. Look at the competitive scenario in that market. Is it highly competitive? Is it less competitive? Are you the only one there, or things like that? But at the same time, when you find that you are the only one there, you might get very excited. But it could be a completely different scenario. If you are the only one in that market, there are only 2 scenarios there. Either you are technologically extremely superior to everybody else, nobody can touch you, or you might be the only person who thinks there is a market where actually there doesn't exist in the market,
Absolutely.
which is why competitors are not there. So be very judicious, analyze it very carefully before getting in there. And of course, your passion, I'm sure you must be having some soft corner towards some patent of yours.
Correct. Exactly.
Very passionate about that. So it's a combination of everything: market, your passion, competition, all of that. So analyze it on these three criteria. Dr. Anudada Ramesh has raised her hand.
Yes, sir. So this
yes,
is just for the funding. Sir was mentioning that it takes about some 15 years also, 45 years also. So if as a startup, as partnership, we put a lot of money into it, and then the return on investment, when you're putting it on. So what would be? How would you do the calculation of it, or how would you go about?
Sure. Okay. Sure. So basically what happens is, as I said, profitability is not a matrix that you really look at in the venture capital world. So how do I make the money? Say, for example, if I invested in your company, that is a startup, okay, say I invested 1 crore, I would have a valuation, say at 10 crore valuation, I invested 1 crore. So I get 10%. So I'm 10% holder in that. Now your company continues to grow, continues to raise funds. So slowly that valuation moves from 10 crores to 20 crores, 20 crores to 30 crores, and it becomes a 100 crore company. Now at 100 crore company, when you become a 100 crore company, you're trying to raise 100 crores. So what has happened is implied, I own 10% in that company. So my one, when I don't sell it, my notional valuation increases. At what happens is at a certain stage, and exit is provided for very early stage investors by the investors that come in at a later stage. So that is how you really make the money. So you will make the money not by growth in terms of profitability, but by growth in terms of valuation. You enter 10% in a 10 crore company, you hold 10% in the company, and now the value is 100 crores. So your 1 crore implied has become 10 crores. That is how you make money.
All right. There is a follow-up question from Neeta Doshi. Okay, when I pitch for one product, should I introduce other products in brief? See, I mean, you don't want to confuse the investor. Right?
Yeah.
If the products are related, and if you have a plan in conjunction, then it makes sense.
Correct.
Like otherwise, it doesn't make sense to confuse your investor.
If there is synergy between the products, yes. Otherwise, no. I mean, then it is like, trying to, really say that, I have 4 companies. Which one would you like to invest in? If you like this, I'll give you this. If you like that, I'll give you that. I mean, it's more negative than positive, to be very honest with you.
The investor will make up his or her mind that, oh, this startup doesn't seem to be sure. Hasn't done.
I mean, on a lighter note, I met someone last week. So, he said, sir, I have a edtech company. I said, I'm not looking at edtech for valuation. He said, chodo na, sir, I have a fintech company also. Wo uska baat karo. So whatever fits you.
So yeah, there's another person, Mayuri Disale has raised her hand. Please go ahead. Type your question in there, please. Mayuri. No. All right. It's Mayuri, you've raised your hand. So if you have a question, you can type in the chat window because you can't unmute yourself. All right. Okay, I think by mistake probably. Anyway, I think we have overshot time. Over to you, Shruti.
Yeah, thank you, sir. So on behalf of V School, we would like to express sincere thanks to our experts today, Dr. Farzan Ghadiali and also Dr. Kaustu Gargalkar. We had an opportunity to hear your thoughts, and this will be surely encourage us to in our future events. A few of the pointers which I could take down as maybe you were suggesting few pointers for young entrepreneurs, like passion and vision is very important. Profitability is not the king. Market share is the king. Patience is very important. Team building is very important. Mainly the alignment of the vision is very important. Chase revenue. Be ready for rejections also, and competitive scenario in the market. We need to keep checking. Even we have to keep checking on our investors. So thank you so much, sir. Farzan sir and Kaustu sir. I would like to give a special thanks to our organizing committee also, and thanks to all the participants for their active participation. Once again, thank you, Farzan sir, for being with us. It has been remained a pronounced pleasure. Have a great evening ahead, all of you.
Just one permission, Farzan. Some people are asking for your contact details.
Yeah, sure. You want me to share it on the chat box?
Yeah, maybe your email ID or something.
Yeah.
I will also share mine. So. All right. Thanks, Farzan. Thank you very much for a
Thank you, everyone. Thank you.
free-flowing session. Thank you. And all the best, budding
you.
startups. Best of luck.
Thank you all.
Thank you all.
Remember, delay your funding. Don't jump into it. Bye.
Thank you.